Welcome back. You're watching Money, Money, Money. And this week we are analyzing a lot of the critical changes that are taking place across the mutual fund universe. Lots of schemes altering their names, some schemes undergoing mergers. And that's all thanks to the application of SEBI's new guidelines with respect to categorization of mutual funds. I'm in conversation with Feroze as well as Azeez. So, gentlemen, let's come down to now what happens if you are in one of these schemes. First of all, I'll ask you first things first. Azeez, when do you need to look at, whether you want to opt out, switch out or not? When should you be worried? I mean, as an investor, suddenly you get to know, okay, now my fund is merging with another fund. What's the first thing that I should think of before making that choice?
So I think this is a good time to review the portfolio and look at the changes that is happening in the underlying funds. So one is a name change, but if the name change is not coming with an underlying change in strategy,
and like the select focus that Feroze explained.
Absolutely, and it is in line with your longer term financial plan, then there is no need to make any change in your portfolio at this point in time. But if the fund is undergoing a name change as well as a change in mandate, right, then that's the time to review whether this fund is in line with your long-term financial objectives, and one can make use of the exit-free period to exit the fund and make those changes.
So in your sort of analysis last couple of weeks, as you're observing all the changes, have you come across any one or two funds where the entire mandate of the fund and maybe its entire portfolio construct is going to go through a change? Anything like that comes to mind? Or mostly has it been nomenclature,
So
etc.?
Within our recommended schemes universe, we've not found too many major changes, to be very honest, because what has happened is, like Feroze mentioned, most of the mutual funds have ensured that their larger schemes continue to be in line with the earlier objective, more or less in line with the earlier objective. They may have had to make some changes at the fringe, so that the investors can continue to stay invested. Although there is one more aspect that one needs to take into account, which is the tax aspect, right? So if you want to exit a particular scheme because the underlying mandate has changed, you need to understand that, if there is a long-term capital gains component, then you'll be taxed when you move out of the fund today. Although you'll get the high watermark of January 31st. Having said that, if it's short-term in nature, then you will have to pay a short-term capital gains tax. So these are two other aspects that one needs to be cognizant of in case you want to move out of that particular fund. The other big fund that I can think which will go a change in the construct is possibly the HDFC top 200, because the top 200 by definition was looking at the 200 stock universe. So it had far more flexibility. Now with the name change happening to top 100,
and it's a pure large cap fund now.
It will become a pure large cap fund, and the universe will get even more restricted. So I guess it will definitely have a bearing on the kind of returns it can generate into the future. Although even the risk will probably be lower, because you're not going into stocks which are beyond hundreds.
Absolutely important points there, and points that one definitely needs to keep in mind. Feroze, I'll ask you the same question. Within larger schemes, does anything stand out for you where you, in your interactions and analysis, are hearing that this is one particular fund or one particular scheme that might be undergoing a big change?
Yes, there are several. Now that you're trying to revamp the entire industry, which is created over years, there is going to be a lot. One thing from a viewer's perspective, from an actionable, first thing you have to see is how many schemes you have, step one. Step two, see if there is any scheme which has not finished a year. If you have all your schemes finished a year, then this exit load free period, more often than not, is not going to help you. If that's the case and you don't have any scheme which is an exit load period, let the dust settle. Because it will take 4-5 months before the dust settles. So sit on the sidelines, watch what's happening, what are the changes happening, and then react. So I would not want to jump in and react unless this exit load period is a beneficial action for me.
But the exit load window, as you explained, is only a 30-day window.
Correct. It's a 30-day window. But automatically...
we're kind of jargonizing, so let me simplify. Basically, you will not have to pay any exit load if you exit within this window of 30 days. And as we were discussing, I think for the HDFC Prudence Fund, that particular fund, that window ends on?
26th of May.
The 26th of May. So, yeah, very little time to act, literally.
Absolutely. Now what happens is, of course, this exit load period is a good benefit for you to move around. But if you've already finished a year, automatically, if you've finished 365 days, most equity funds don't charge you an exit load. So you might be finishing your year in August. So it's okay. You don't have to use the exit load period. If you wait till August, then you will anyways in the exit load free period.
Sure.
So point one is see how many funds you have. Point two, see how many have not finished a year. If you have ones which have not finished a year, then that exit load period is good. Otherwise, stay the course, see the light at the end of the tunnel in terms of what are the changes, and then react according to the external factor.
So final thoughts, gentlemen. I mean, this is obviously a major disruption in the industry that's going on. Once the dust settles, the question is whether we will be better off or not. I mean, do you think, Ashish, it's going to meet the objective of simplification, transparency that SEBI set out with?
Look, it's a small step in the right direction. At least what they've done right now is homogenize the way the schemes are evaluated and benchmarked. And they've also set a common universe for schemes in similar categories. However, I mean, one of the objectives of reducing complexity and reducing the number of schemes available to investors, according to me, has not been met. I mean, we were doing the maths, and there were roughly about 530, 540 schemes before this entire circular came out. And, you know, after the circular has come out, I guess in a few months, you'll have similar or more number of schemes. Because what is happening is a lot of the smaller asset management companies didn't have schemes in some of these categories, and they're now free to launch more schemes in those categories. Sure. So I think it's a small step, but it is, I believe it's a journey, and it's a step in the right direction. They need to make more changes to ensure that mutual funds as an asset class becomes a simpler way to invest for, you know, retail investors, and you know, we get more penetration in the savings pool. Fair
enough. Feroze, any last thoughts from you?
In my opinion, it's a very big step. Why is it a big step? Of course, when the circular came, most fund managers said this is going to be hardly any change. But this is a very, very big step. Point one. Point two, it's very well thought out. Why is it very well thought out? If I give you an illustration of a component of what is being said, is two different benchmarks are being launched. Which of investor or a viewer needs to familiarize himself or herself with. That benchmarking will bring in transparency. The third thing is the fund manager is now going to be mandated. This is the third point. It says, little do any investor knows that indices which they do comparison with does not include the dividend. Now they've mandated to include the dividend back. That's what is called the total return index. So this is very well thought out. So many moves at once. Of course, it's going to take a year for things to settle down, but I think it's a big step in the right direction, in my opinion.
Well, it's an interesting time that we are in the midst of. And definitely, as investors, we need to keep taking note of all of these changes. So you keep your eyes and ears open. And of course, we here at Money, Money, Money will do our best to make sure that we give you all the information that empowers you. Gentlemen, thank you very much for joining in and analyzing a lot of these very confusing trends for us. Well, that's it on this week's episode. Thank you for watching. We'll see you again next week.